John A.G. back with you. And what unfolded overnight wasn't just another round number getting taken out on a chart. This was something much bigger, something structural, something that changes how the financial system actually functions. Gold didn't simply break a psychological barrier. It shattered a line that had defined market expectations for decades. As I'm recording this, gold printed $5,012 in the overnight session. And while mainstream financial media is busy searching for dramatic headlines and clever adjectives, they're completely missing the real story. Because the number itself isn't the story. The story is what that number is telling us. Gold at $5,000 is the market screaming that confidence in the current monetary system is collapsing. And while everyone is staring at gold, the real move, the explosive move, is setting up in silver, which is now pressing against the doorstep of $100. And let me be clear, this isn't hype. This isn't speculation. This is the market finally admitting what many of us have been tracking for months behind the scenes. The gap between physical supply and paper pricing games has grown so wide that it can no longer be contained by algorithms, derivatives, or coordinated short selling. If you're waking up on February 14th, 2026, seeing these headlines, you need to understand why this is happening right now, and why the next 48 hours could be critical for silver. So let's cut through the noise and look at the data. Because what crossed trading terminals late last night in the US session was nothing short of stunning. Gold didn't just drift past $5,000. It exploded through it on the back of a massive liquidity injection that we first started seeing hints of earlier this week in the repo market. At the same time, something far more serious happened. The Treasury market started to malfunction. And mainstream outlets are barely touching it. We saw the 10-year yield spike toward 5.5% at the same time gold was rallying hard. Now, normally, yields rising should pressure gold lower. That inverse relationship is something every economics textbook teaches. But this time, both moved up together. And when bonds sell off, the dollar weakens, and gold surges simultaneously, that tells you something important. Capital isn't rotating within the system. Capital is trying to escape the system. Investors aren't shifting sectors. They're looking for assets without counterparty risk. And right now, that safe harbor is physical metal. Now here's the part many analysts are missing while they celebrate gold's milestone. This is where silver becomes unavoidable. The gold to silver ratio, which has been artificially elevated for years to mask monetary stress, has collapsed rapidly, falling from around 90 to 1 down toward 50 to 1 in just weeks. With gold around $5,000, silver trading near $92 tells us the market is beginning to price silver as money again, not just as an industrial metal. And then this morning, Shanghai opened with premiums that absolutely break the Western pricing model. Physical silver there is trading nearly $14 higher than paper prices in the West. That gap is unsustainable. And it signals something critical. Eastern physical markets are no longer accepting Western paper pricing as legitimate. But what I'm about to tell you next is the data point that changes everything for the delivery month ahead. Yesterday's latest COMEX Vault report showed registered silver, meaning silver actually available for delivery, dropping below 50 million ounces for the first time ever. We're looking at roughly 48 million ounces available, backing more than 320 million ounces of open contracts standing for delivery next month. That's nearly a 7-to-1 coverage ratio. In any normal market, that kind of imbalance would shut trading down immediately. But here we are, watching regulators stay silent while banks scramble to roll contracts forward to avoid delivery obligations. And here's the problem they now face. The long positions aren't rolling forward. They want metal. Reports showed major bullion banks offering cash settlements at premiums to convince traders not to take delivery, and those offers were rejected. People want the physical metal. And that refusal is what lights the fuse toward $100 silver. Technically speaking, the chart setup is just as explosive. Silver closed the US session around $92.40. But the bigger story is that it broke out of a multi-decade cup and handle pattern on the weekly chart with massive volume confirmation. Trading volume now exceeds what we saw during the run toward $50 back in 2011. And that tells us this move isn't retail speculation. It's institutional accumulation. Above current prices, there isn't meaningful resistance until the inflation-adjusted highs near $140. But psychologically, $100 is the next big battleground. Once that level breaks, we enter price discovery territory. And right now, algorithms are clearly trying to cap prices below $95. But every sell attempt is being absorbed instantly. Buy orders keep reappearing. That tells you buyers are aggressive and patient. Now let's zoom out and look at the geopolitical layer, because gold's breakout is directly tied to developments we discussed previously around the BRICS settlement system. Just days ago, the BRICS coalition announced the launch of a new settlement unit for trade transactions, operating independently from Western currencies and backed partially by gold. That announcement didn't explode across headlines, but its impact was immediate. Central bank buying activity in London surged. Sovereign buyers are not selling gold at $5,000. They're accumulating it. Because gold is now acting as neutral collateral between nations losing trust in each other's currencies. Russia and China have effectively placed a floor under gold prices, making it extremely difficult for Western central banks to suppress prices without damaging their own balance sheets. And silver becomes collateral damage in this monetary chess game. For anyone new here, let me clarify something important. I don't sell signals. I don't run managed accounts. And I will never ask you for money. If someone in the comments pretends to be me offering investment advice, report them. I'm here strictly to break down exchange data, vault reports, and market mechanics the mainstream ignores. And if this analysis is helping you see what's really happening, comment OG John AG below so I know who's actually paying attention rather than just chasing hype. Now let's circle back to the physical market because this is where pressure is becoming undeniable. Dealers across North America and Europe are reporting almost no inventory for immediate silver delivery. Premiums on coins and bars are now exceeding 25% above spot price. Think about that. If silver were truly $92, you'd be able to buy it near $95. But many buyers are paying $115 to $120. That tells you the spot price is becoming disconnected from physical reality. Large wholesalers are even offering to buy back-stored metal above spot just to meet industrial demand, especially from solar and EV manufacturing sectors that simply cannot substitute silver. Industrial demand creates the floor. Monetary demand breaks the ceiling. But discipline requires us to also look at the bearish case. And that argument revolves around a sudden liquidity event. If credit markets freeze and leveraged funds are forced to liquidate positions, metals could temporarily fall as investors scramble for cash. A stock market crash could force algorithms to dump everything indiscriminately, potentially sending silver briefly back toward $80. However, this scenario is weaker today than in past cycles, because this time physical supply is tight. Paper price smashes would likely trigger immediate buying and delivery demands, accelerating exchange stress. In other words, downside risk is limited by physical reality. And then we have the macro catalyst many are ignoring. Yesterday's CPI numbers showed inflation accelerating again towards 6%. The Federal Reserve is trapped. Raise rates further and banks break under unrealized bond losses. Cut rates and inflation spirals out of control. Markets understand there is no painless exit. The dollar index hovering near 92 becomes critical. A break below 90 could unleash massive foreign capital flows into metals as protection, not speculation. Combine this with silver's fourth straight year of supply deficits, and you're looking at a compressed spring ready to explode, and gold breaking $5,000 may have just triggered that release mechanism. Looking ahead, we now approach the US President's Day holiday, meaning American markets closed while Asian markets remain open. Historically, this thin liquidity window allows large players to attempt price control maneuvers. We could easily see a final aggressive future sell-off attempt while US traders are offline. But if silver holds strong and Shanghai premiums stay elevated through that window, it confirms that price control has shifted toward physical buyers in the East. Watch Shanghai pricing closely. A strong close there while US markets are shut would set up an explosive reopening. And finally, we must discuss mining stocks because something important is changing. For the first time in years, miners are outperforming metals themselves. The GDX index surged sharply this week, signaling capital rotating into producers benefiting from current prices. If silver breaks $100, primary silver miners move from survival margins to enormous profitability. And when smart money shifts from metal ownership to mining equities, it often signals a sustainable bull market, not a final blow-off top. And that brings us to the question I hear constantly. John, when do you sell? And the answer requires changing how you think. We are not trading a cycle anymore. We are living through a monetary regime change. If $5,000 gold becomes the new floor, selling silver at $100 might someday look like selling gold at $400 back in 2005. This isn't a trade. This is positioning for systemic change. And right now, we're still early in that transition. And that transition is still unfolding. A lot of people watching right now are still thinking in trading terms: entries, exits, short-term price targets. But what we're witnessing isn't just another bull market cycle. It's a restructuring of how value itself is measured. And when systems change, prices don't move smoothly. They move violently. Confidence erodes slowly, then collapses all at once. That's why the question shouldn't be, can silver hit $100? The real question is, what happens after it does? Because once silver breaks into triple digits, we move into territory where there's no historical roadmap, no overhead resistance, no past price memory telling traders where to sell, just raw supply and demand. And right now, supply is the weakest it has been in decades. Let's talk about mining supply for a moment, because many people assume high prices automatically bring new production online. But mining doesn't work that way. It takes years, sometimes a decade, to bring new mines from discovery to production. Environmental approvals, financing, infrastructure, political risk, all of it slows expansion. And here's the key point. Most silver isn't mined as a primary product. It comes as a byproduct from copper, zinc, and lead mining. So unless those industries dramatically increase production, silver supply doesn't magically surge just because prices go higher. Meanwhile, demand keeps rising. Solar installations continue expanding globally. Electric vehicles require silver in electronics. Data centers, power infrastructure, medical applications. All of them consume silver in ways that aren't easily replaceable. And when monetary demand collides with industrial demand, shortages accelerate. That's the squeeze we're entering now. But let's step back for a moment and talk psychology, because markets move on emotion as much as fundamentals. Right now, most people still don't own precious metals. Retail investors are still chasing tech stocks, AI narratives, crypto volatility, or simply trying to keep up with rising living costs. Precious metals remain underowned relative to historical monetary crises. And that's why this move has room to run. The public hasn't arrived yet. Historically, the final phase of a metals bull market comes when everyday investors rush in, when news anchors talk about gold prices nightly, when coin shops have lines out the door. We're not there yet. What we're seeing now is early institutional repositioning and sovereign accumulation. The crowd shows up later. And when they do, moves accelerate beyond what most people think is possible. Now, I want to address something important for viewers trying to navigate this environment responsibly. Volatility is about to increase. Moves up will not be smooth. There will be sharp corrections, violent pullbacks, and sudden price swings designed to shake out weak hands. That's how markets transfer assets from emotional participants to disciplined ones. If you're watching price every hour, you'll feel like the sky is falling during corrections. But if you zoom out, the structural trend becomes clear. The bigger risk right now isn't short-term price fluctuation. The bigger risk is holding assets that depend entirely on trust in financial institutions while that trust is eroding. And that's the shift many people are only starting to recognize. Central banks are buying gold. Nations are bypassing dollar settlement channels. Bond markets are flashing warning signs. This isn't random noise. It's systemic stress. And silver, historically, moves late, but violently, once monetary demand wakes up. Which brings us back to the near-term timeline. The next few trading sessions matter enormously. If silver pushes through $100 while COMEX inventories remain tight and Shanghai premiums stay elevated, then we're looking at a potential delivery crunch scenario. And if exchanges struggle to deliver physical metal, confidence in paper pricing collapses rapidly. That's when repricing becomes disorderly. The banks know this, which is why we may see one last attempt to control price through aggressive futures selling, margin changes, or liquidity maneuvers designed to force weak holders out. Expect turbulence. Expect fear campaigns. Expect headlines predicting crashes, because that's how positioning battles are fought. But here's the reality. Physical buyers don't care about paper volatility. Industrial consumers need metal regardless of price swings. Sovereign buyers accumulate strategically. Long-term holders aren't trading noise. And that's why dips are being absorbed faster than ever. Each sell-off finds buyers waiting. Each attempt to push price down runs into real demand. Now, let's talk about timing again, because people always want certainty. Nobody knows the exact day silver breaks $100. But markets telegraph moves through pressure buildup. And right now, pressure is everywhere. Vault inventories shrinking, premiums expanding, institutional buying increasing, monetary policy trapped, currency confidence weakening. All these forces converge toward one outcome: repricing of tangible assets. So the mindset shift becomes critical. Instead of asking, how high can silver go this month? The better question becomes, what role do real assets play in a world where currency trust is eroding? Because this isn't just about profits. It's about purchasing power preservation. History shows that during monetary resets, holders of tangible assets preserve wealth while holders of purely financial assets suffer dilution. That's the broader context. And it's why this move matters beyond trading screens. So as we wrap this up, let's bring everything into focus. Gold above $5,000 isn't just a milestone. It's a signal that confidence in the old system is cracking. Silver approaching $100 isn't speculation. It's consequence. Consequences of debt expansion, currency debasement, geopolitical shifts, and supply constraints all colliding at once. And while volatility will shake many people out, the underlying forces driving this move aren't going away next week or next month. They're structural. So stay disciplined. Watch vault inventories. Track physical premiums. Pay attention to delivery data, not just price charts. Ignore emotional noise. Because right now, markets aren't playing games. They're rewriting the rules. And if you understand what's happening, you don't panic during volatility. You position accordingly. This is financial warfare. And knowledge, combined with disciplined positioning, is your strongest defense. John A.G. signing off. Stay sharp.